The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and a warm welcome to all. I am Ridul on behalf of Care Ratings. Welcome you to our today's webinar on housing finance companies, where we'll be discussing on performance, regulations, and opportunities. Appreciate your time in joining us for this webinar. Our speakers for today is Mr. Sanjay Agarwal, Senior Director at Care Ratings. Mr. Mitul Budhbhatti, Head BFSI and Structured Finance, will be joining us from our Ahmedabad office. Saurabh, Bhalerao, Associate Director, along with him, Purnima Nair, Research Analyst. The discussion is in form of a presentation which is visible on your screen. In case of queries, you are please requested to key in the questions. We will be having a separate Q&A session no sooner the presentation ends. May I request Sanjay sir to begin the proceedings?
Thank you, Mridul, and good afternoon to all of you. Indian economy has continued to grow at a smarter rate compared to the other countries in the last few years. However, the growth in the last few quarters has been subdued when compared with the earlier quarters. Indian real estate plays a vital role in the economic development of the country. Real estate as a sector accounts for significant proportion of the employment and constitutes almost 6% of the GDP. The overall slowdown in economy, along with domestic factors such as NBFC crisis, developer defaults and bankruptcy, and the reduction in private consumption, which is the backbone of demand and investment in the overall economy, have all slackened the sentiments in the market. Regulations like RERA and Insolvency and Bankruptcy Code have been fixing accountability on developers, which has improved consumer and investor sentiment towards the sector. The renewed focus of the government on the housing sector has made housing the most financed asset class amongst all the other retail asset classes, as it forms about 60% of the total retail advances deployed by HFCs, NBFCs, public sector banks, and private sector banks. With housing being accorded infrastructure status in 2018 budget, the importance of the asset class has further increased. However, the housing finance market continues to face considerable supply constraints. We need to have constant discussion and debates on how to grow the housing finance market, with the government contributing towards supportive programs and regulations, and the private sector supplementing with technology solutions and innovative products. In the webinar today, we would provide an overview of the housing finance, of the performance of housing finance companies based on advances, borrowings, and profitability, and of securitization volumes and policy initiatives. Rating perspective and outlook would also be discussed. Now I hand over to Saurabh and Purnima to continue with the presentation.
Thank you, Sanjay. Housing finance is a highly competitive credit space with presence of scheduled commercial banks, cooperatives, NBFCs, and housing finance companies. In the late 70s, the government set up the Housing Development and Finance Corporation to improve credit access to the housing in India, and later formed the National Housing Bank, which was made the apex body supervising the activities of housing finance institutions in India. HDFC was privatized in the post-liberalization years, and with this move, a number of public and private housing finance companies were formed. With affordable housing accorded infrastructure status, the housing market has been further streamlined and is held at par importance with other major infrastructure segments. The main aim of HFCs is to provide capital to individual borrowers and to developers at the land and pre-approval stage for the development of affordable and mid-income housing in India. The Indian housing finance market reached a size of over lakh crores as of FY19, witnessing a CAGR of 15% for the last 5 years. The housing finance industry has exhibited further remarkable resilience over the past two broad economic cycles. However, in the first half of 20, HFCs experienced deceleration in credit growth and muted profitability as market conditions in the sector waned. The liquidity stress faced by the NBFC sector led to sharp deceleration in the growth of the credit extended by HFCs. Further, the banks also purchased housing loan portfolios through securitization transactions from other entities. Hence, the stock of loans outstanding may not reflect the change in the proportion of disbursements made by different lenders. On the other hand, bank credit to the housing sector picked up and grew at a robust pace in finance, partially making up for the slowdown in HFC credit and adversely affecting their profitability. Since August, HFCs have been brought under the regulatory purview of the Reserve Bank of India. If you'll notice, despite this slowdown, the NBF in growth, the NPAs in retail housing loans continue to be lower as compared to the other asset classes. As it further, if you look at the further breakdown, housing loan asset class recorded lower delinquency levels as compared to other asset classes, auto loan against property. Uh, as the typical home loan borrower in India is a salaried individual who earns a fixed monthly income, the repayment schedule of a home loan is thus adhered to with the least amount of certainty. Hence, the delinquency in the HL asset type are the least, and asset class is thus considered to be the lowest risk. As the above chart gives the market share of housing loans outstanding between banks and HFCs over the years. As can be seen, the HFCs have gained market share earlier. However, in the aftermath of the events during September 18, the share of HFCs in the HL market has stagnated. On account of the tight liquidity scenario in second half of 19, major HFCs had to temporarily withhold disbursements to maintain the essential liquidity. Further, the banks also purchased housing loan portfolios through securitization transactions from other intermediaries. The housing growth prospects continue to be bright, driven by a low mortgage penetration. As in the earlier part of the independence, government had taken up the sole responsibility of ensuring the construction of the economic framework. Hence, it broadly assigned a broad role for itself in the housing industry. The 5-year plans were instruments through which government would intervene in the markets to providing housing for people, which this perspective has been modified post-liberalization. Housing finance as an instrument of credit can be availed by individuals who have a long working life ahead of them, during which the loan can be repaid. The acquisition cost of a house in India is a sum of various costs. One of the key ownership methods for housings is the home loans, that is mortgages. Mortgages have been a popular means of facilitating the purchase of a house across all segments. Even though the needs and product requirements vary significantly across segments, India has a very low mortgage to GDP ratio compared to other countries. This ratio is expected to grow significantly over the next few years, contributing to the growth of the market. The other drivers also include improved affordability, government incentives such as PMAY, enhanced fiscal benefits, credit-linked subsidy schemes. Other drivers include favorable demographics, as around 66% of India's population is below 35 years of age, hence signifies a large portion for housing loans. Nuclear families. A rise in the number of households, the shift toward nuclear families also increases the number of housing units, driven by further urbanization and interest rates, improved affordability through rising disposable incomes and affordable interest rates in home loans. If we look at the chart, enumerate the different types of home loans offered to various criteria of borrowers. Loans extended by the HFCs include housing loans and non-housing loans. Retail housing loans or individual loans comprise of 3 primary types: for acquisition of new homes, for upgradation, and for acquisition of old homes. Wholesale housing loans are disbursed to builders operating in the housing space and to corporate bodies. HFCs also extend loans against property, which can be for both retail and wholesale. Now I'll ask my colleague Purnima to speak on the HFC advances, borrowings, and return ratios for the sector.
Thank you, Saurabh, for providing the perspective on housing finance industries. Housing finance companies, or HFCs, are the most important avenue of housing finance next to banks. Presently, there are 101 HFCs registered with the NHB, of which 18 are deposit accepting. HFCs have a localized base of operations. Every region has a couple of major players and a few smaller ones. For a financing institution to be registered with the NHB as an HFC, it is mandatory to record 70% of the on-book loans as housing loans. Further, to be eligible for refinance from NHB, the HFC has to record 50% of retail home loans on its loan book. In the Union Budget of 1920, the regulatory functions of NHB were proposed to be transferred to the RBI. The central bank is yet to issue guidelines on the same. Given that the HFCs would be under the regulatory ambit of the RBI going forward, the supervision of the HFCs is expected to be on terms congruent to that of NBFCs. Moving into the historical performance of HFCs. Housing finance gained momentum after the income tax rebate on home loans was introduced in 1999. Owing to the tax advantage and growing income level, the period of 2005 to 2010 is characterized by rising demand for housing. Further, the number of new HFCs established post 2008 has considerably increased. Since most of the new HFCs had a parentage with banks or NBFCs, the overall leverage of HFCs remained close to 6 times. The number of HFCs more than doubled from 43 in 2008 to 91 in 2018. This period is also marked by a shift in the borrowing profile of HFCs from banks to debt sources. The advances of HFCs recorded a 10-year CAGR of 21.6%, growing from 1.5 lakh crores in March 2008 to 10.4 lakh crores in March 2018. On the liability side, as of March 2008, 40% of the borrowings were funded by banks alone, while around 51% came cumulatively from capital markets, foreign borrowings, and from the NHB. By 2018, the share of borrowings from banks reduced to 24% of the HFC's total borrowings, while that of debentures and other borrowings rose to 60%, indicating that the availability of cost-efficient debt borrowings for the non-bankers. Here, the other borrowings of HFCs include funds raised through short-term instruments. In the years post demonetization, FY15 and FY16 to 18, the excess liquidity was parked in the debt raised by the HFCs and NBFCs. The deployment of mutual funds in NBFC debt instruments, which include issuances by HFCs, grew by 50% in FY17 and further by 24% in FY18. As a result, the debenture borrowings of HFCs recorded a year-on-year growth of 35% in FY17 and further by 21% in FY18. Public deposits, though an expensive avenue for securing funds, is utilized by the HFCs mainly to establish their presence in Tier 2 and semi-urban markets. However, keeping in mind the interests of the retail investor, the regulators have from time to time put in place a number of checks and balances to prevent misuse of the public deposits by the HFCs. The period 2013 to 18 saw housing loans grow at a CAGR of 21%, while that of non-housing loans has been higher at 23%. The housing loans formed approximately 72.5% of the total advances of HFCs at the end of March 18, as compared with 74.4% in March 13. The chart on the right depicts the year-on-year growth in different types of loans extended by the HFCs. The non-housing loans have been growing rapidly from 27% in March 17 to 28% in March 18, while the housing loan growth stood at 17% and 26% respectively. Thus, the growth in advances of HFCs between March 2016 and March 2018 has been fueled partly by the creation of non-housing assets, that is, via LAP, loan against property. The yield earned on LAP assets is higher than the retail HL assets, given that the delinquency on LAP is much higher, as Saurabh had explained some time before. Hence, the HFCs resort to lending via LAP in order to secure higher margins over their cost of borrowings. Further, the HFCs cater to the unbanked borrowers, both retail and wholesale, to whom banks are unable to lend due to the high risk associated with the segment. and hence HFCs face very little competition from SCBs in the market space of non-housing loans. The asset quality of HFCs thus appears to have been affected by the rising share of non-housing loan, as the GNPA ratio rose from 1.1% in March 17 to 1.31% in March 18. Gross NPA amount rose to 50% from in YOY terms from 9,085 crores in March 17 to 13,602 crores in March 18. Coming to the performance of a sample of 22 major HFCs in FY19. We have sampled 22 major HFCs with an asset size of above 1,000 crores. 9 of these HFCs are deposit accepting. In FY18, the loan book size of these 22 HFCs form 88% of the aggregate advances of the HFCs at industry level. The HFCs operate in a very concentrated space where 5 major entities comprise 9.7 lakh crores or of the 11.6 lakh crores of the sample's total asset size. During FY19, there has been a clear moderation in the growth of 22 sampled HFCs, both on liability and asset side. On the asset side, the loan book growth moderated from 23.8% to in March 18 to 10.3% in March 19, as the HFC slowed down their disbursements in order to conserve liquidity. Further, certain HFCs resorted to sell downs or securitization of their retail assets in order to generate liquidity. This has brought down the share of the retail loan book in their outstanding advances. The HFCs record nearly 50% growth in investments, as a couple of large HFCs made investments in their subsidiaries. On the liability side, liquidity concerns owing to risk-averse investor perceptions were affecting the borrowing sources of non-bankers. The growth in the borrowings of HFCs moderated from 17.9% in March 18 to 14.9% in March 19. The deposit accepting HFCs have been sourcing a major part of their funds via public deposits, as the component records 13% growth in March 19 as compared with 9.9% growth in March 18. All of the HFCs witnessed an infusion of equity during FY18 and hence the sharp growth of 34.6% in March 18. The leverage levels of HFCs hence stood at 6.3 times in March 18. Furthermore, there is a sharp spike in the leverage levels of sampled HFCs once HDFC Limited, a major HFC, is removed from the sample, as the performance of the other entities is often masked by HDFC due to its sheer asset size. As of March 19, the sample of HFCs excluding HDFC operated at a high leverage of 8.5 times as compared with 7.7 times in March 17. Going into the performance of the assets of these sampled HFCs. The share of asset class and advances of the sampled HFCs has been calculated from the breakup of the loans and advances given in the annexures of the respective HFCs' annual reports. The share of housing loans stood at 73% in March 19, as the asset quality of the sampled HFCs has declined marginally in the housing loan assets, indicating the rise in the NPA and developer loans held by the HFCs. The rise in the builder loans over the last couple of years has led to the deterioration in the asset quality of those HFCs which have an exposure to retail and developer loans. The builder books have been affected by lower operational efficiency of the developers and rise in the financing costs, which have affected their pace of project completions and further have affected their loan repayments to the HFCs. For smaller HFCs, the retail assets held in the housing loan portfolio have moderated on account of securitization. The GNPA level of non-housing has thus improved as HFC sought to focus more on the creation of retail assets in the second half of FY19. The magnitude of GNPA loans remains more or less similar for both March 18 and March 19. Further, a major part of non-housing NPA was provided for in March 19 and FY19 itself. Coming to the borrowing mix of the HFCs, sampled HFCs. The borrowing mix of HFCs witnessed a change as they moved back towards bank borrowings as of FY19, whereas earlier their borrowings via capital markets were pretty high. The bank borrowings of HFCs comprised of 29% share of total borrowings of HFCs in March 19 as compared with 24% in March 18. Further, the borrowings via commercial paper have considerably declined from 11% in March 18 to 8% in March 19. The share of debentures has also moderated marginally. The table on the right gives a monthly trend of debt issuances, both corporate debt and commercial paper for FY19. The total amount of debt issuances post November 18 has been declining cons- uh, consistently. During H1 FY19, HFCs were highly dependent on CP borrowings and hence were faced by concerns of asset liability mismatch as there was a tendency to borrow in the short term. Post September 19, the CP issuances declined considerably. Only larger HFCs with strong fundamentals were able to source funds from the debt markets during H2 FY19 as coming to the profitability of the sampled HFCs. The HFCs were able to maintain their profitability in FY19 despite the slowing growth in their advances. The sampled HFCs record a rise in their ROTA from 2.2% to from 2.2% in March 18 to 2.3% in March 19, majorly on account of decline in their provisions. Most HFCs provided for their stressed assets as per the expected credit loss norms while reporting their financials post March 18. The entities have had to restate their income and impairments on financial instruments of FY18 as per Ind AS. Hence, the sharp decline in provisions of HFCs in FY19. Though the asset quality of HFCs has declined at the end of March 19 as they were securitizing their retail assets, yet the overall level of NPA remains under control as compared with other asset classes. The ROTA chain indicates that rapid growth in loan assets of HFCs until March 18 has led to a rise in their interest income. Their interest expense as a percentage of total assets has risen only marginally, indicating a sharp rise in cost of borrowings of only some HFCs. As a result, the HFCs have been able to conserve their NIMs and ROTA at levels similar to that of March 18. The total income of the sampled HFCs record a moderation as a major entity had recorded a large amount of gains of investment during FY18. Coming to performance of the sample for H1 FY20, here the sample excludes an HFC that has been merged with a bank and with an HFC that went into IBC. The performance of HFCs has been muted for the first half of FY20. The year-to-date growth in advances of the sampled HFCs stood at 3% as of September 19. The 7 deposit accepting HFCs in the sample have recorded a considerable growth in their public deposits, where one of the bank-backed HFCs has raised their deposit base by expanding their network of branches. The profitability of the sampled HFCs has been affected by both a rise in provision and moderation in interest income. The moderation in interest income comes on account of slow growth in the advances of HFCs. Their NIM is declining as it stood at 2.9% in March 19 and 2.5% at the end of September 19. The capital market borrowings have also slowed in H1 FY20. Hence, the year-to-date growth in borrowings stood at 0.2% as of September 19. The total debt issuances of HFCs for the period of April to October 2019 has declined by 38% as compared with April to October 2018. Coming to the yields and spreads at which the debt instruments of HFCs are traded, there is a clear indication that the investors' risk perception towards HFCs is moderating as the yields have moderated post February 2019. Same goes with the spreads at which the debt instruments of HFCs are traded. Coming to the securitization transactions made by the HFCs. The ALM mismatches led the HFCs to liquidate their assets via securitizations or sell downs. The securitization takes place via PTCs, that is pass-through certificates, which act as a debt investment instrument via direct assignments, also known as sell downs of loan assets. PTCs are more favorable option as it does not affect the loan book of the investor. DAs, on the other hand, go in as an addition to the loan book of the investing entity. Banks take up DAs from HFCs in order to maintain their mandated exposure to the priority sector lending under the housing sector category. The total loan securitization undertaken by HFCs, NBFCs, and MFIs stood at an all-time high of 1.8 lakh crores, which is a growth of 146% in year-on-year terms. HFCs had approximately 50% share in the total amount of asset securitization, that is 93,000 crores. The HFC securitized assets worth rupees 87,522 crores via DAs and 5,495 crores via PTCs during FY19, as compared with 3,660 crores of PTCs and 34,317 crores of DAs during FY18. The sharp rise in securitization volumes were recorded majorly during H2 FY19. As can be seen in both these charts, the share of HFCs in direct assignment transactions is higher than their share in the PTC transactions. The share of HFC stood at 67% of the total DA transactions in FY19 and the PTC transaction amounted to 9% as of H1 FY20 of the total PTC transactions in the industry. Coming to the recent government initiatives made to support housing finance in India. The NHB notified HFCs to discontinue loan products that involve payment of interest on loan amount by builders or developers on behalf of the borrowers. The scheme has been a market practice for years, wherein the developers are funded for a relatively shorter period on the basis of the borrower's credit record. In such an arrangement, however, the borrowers and the lenders are exposed to substantial risk from the developers. The direction is likely to impact the sales velocity of the developers, as the product was majorly used to attract bookings. Secondly, the NHB brought down the total borrowings of HFCs to 12 times their NOF and raised the capital adequacy to 15 times. Both these revisions are to be undertaken in a phased manner. Further, the deposit accepting HFCs are allowed to accept public deposits amounting only up to 3 times their NOF. The reduction in the borrowing limits would reinforce discipline amongst HFCs, while an increase in the minimum CAR level would strengthen their balance sheets. The regulation is not likely to create a major impact for smaller HFCs as they operate at a lower leverage level. Further, large entities which maintain CAR above 15% may revisit their CAR policies and set new cushion above 15% level. The NHB initiated the Liquidity Infusion Facility Scheme in December 19 for housing finance companies with an scheme allocation of up to rupees 30,000 crores. Under this scheme, the separate provisions on eligibility of HFCs, amount of refinance, security for refinance at the end of the utilization period of 6 months, and interest rate have been made based on the internal rating of the entities. Entities up to B as internal rating have been categorized as Lift 1, and those with rating C have been categorized as Lift 2. In addition to the existing norms for ECBs or affordable housing, further relaxation in ECB guidelines to facilitate financing for home buyers who are eligible under the PMAY. ECB relaxation benefits the companies in the affordable housing space as it would reduce their borrowing costs, thereby bettering the project economies. Further, ECB's financing of home buyers who are eligible under PMAY would also reduce the borrowing costs, thereby increasing the demand. Further, the second measure is aimed at the government employees could encourage them to buy new houses. The partial guarantee, the government in its 2019 union budget announced to provide for a one-time 6 months partial guarantee to the PSBs for investing in high-rated pool assets for financially sound NBFCs and HFCs up to rupees 1 lakh crore during FY20. Further, the government provides the first loss default guarantee up to 10%. Though the measure is a sound beginning, there are further steps that need to be taken to boost liquidity for HFCs. The NHB removed the requirement for creation of DRR of 25% of the value of outstanding debentures with respect to listed companies, NBFCs registered with the RBI, and HFCs. Further, the requirement for creation of a DRR of 25% of the value outstanding debentures in respect of the listed companies, NBFCs, and HFCs for public issue as well as private placements has been removed. A majority of the borrowings by NBFCs and HFCs were already from private placements. While the requirement for DRR has been removed, the stipulation for maintaining 15% for the next 1 year for the next 1 year's repayments as a reserve fund continues. The stipulation was earlier applicable only to companies where DRR was applicable. That is, it would only apply to HFCs which issued public debt. Hence, clarity is required on whether the requirement of this reserve fund would be applicable to all debt issuances. To focus on the construction of unfinished units, a rupees 20,000 crore fund would be set up, which is 50% of the 10,000 crore would be contributed by the government and the balance by outside investors. This fund would provide last mile funding for housing projects, which are non-NPA, non-NCLT projects and are net worth positive in affordable and middle income category. The fund would ensure many affordable and MIG projects stuck because of last mile funding requirements, subject to not being under NCLT or NPA, will be able to get completed and is expected to benefit around 3.5 lakh home buyers. Definition of affordable housing is clear. However, clarity is required on the definition of middle income housing, as this would determine the applicability of this benefit to such projects. Finally, in a recent move, the RBI has constituted a committee to study the prospects of the housing finance securitization market. This report, for which has been submitted earlier this year. The report suggests ways to develop the housing finance securitization market so as to bring HFCs at par with best international practices. I now hand over the presentation back to Mitul sir, who would continue with the discussion on ratings and outlook for the sector.
Thank you, Purnima. We'll now move on with the discussion. We would look at the key rating drivers that CARE looks at while assessing housing finance companies. Next slide. So the key factors considered while assessing the housing finance companies include capital and leverage, asset quality, profitability, liquidity, resource profile, management, and size and market presence. Capital and leverage. The level of capital determines the ability of the housing finance company to absorb losses arising out of its business and provides cushion to its lenders against such losses. A high capital adequacy ratio also indicates the ability of the housing finance company to undertake additional business. CARE looks at the management's approach towards maintaining a high cushion over the regulatory capital adequacy ratio in light of the portfolio mix of the HFC, along with the corresponding trend in delinquencies and portfolio concentration. CARE looks at the debt to equity ratio of the HFC as a leverage measure. An HFC's leverage is a function of its business mix, growth potential, delinquency trends, and portfolio concentration, among other factors. While relatively higher leverage is acceptable for granular and stable products like prime retail loans, A lower leverage may be warranted for portfolios which are either more concentrated, for example, corporate and builder loans, or the ones which exhibit a relatively higher risk of delinquencies. Demonstrated ability of an HFC to raise adequate equity capital from varied set of investors is viewed favorably. Similarly, demonstration of support to an HFC through equity infusion by a strong promoter group or a parent institution is also viewed favorably. Moving on to asset quality. Asset quality is one of the most critical parameters while assessing HFCs. Apart from traditional home loans to salaried individuals, HFCs also lend to self-employed individuals and individuals belonging to mid-income or low-income groups. Such loans exhibit greater credit risk and are priced higher vis-à-vis the prime home loans. Apart from housing loans, HFCs also extend loan against property and real estate construction loans, which exhibit a different risk behavior. The credit costs of an HFC are primarily impacted by the level of delinquencies observed in the loan portfolio. Now, worsening of the delinquencies in the loan portfolio not only suppresses the profitability through higher credit costs, but also puts pressure on capital cushion available to absorb losses and can lead to restricted access to funds from the market, resulting in subdued growth prospects. CARE looks at the non-performing assets, the GNPA ratio, and the overdue loans as a measure of asset quality. Profitability. Profitable operations are essential for HFCs to operate as a going concern and generate internal capital which can be deployed for future growth. Profitability is gauged through trend in return on total assets and return on net worth. The contributing factors to the HFC's profitability are assessed and studied for its overall impact on the profitability ratios. The major ones include interest spread, net interest margin, other income, operating expenses, and credit costs. Each of these elements are analyzed separately to assess its overall impact on an HFC's profitability. Liquidity. Lack of liquidity can lead to an HFC towards failure, while strong liquidity can help even an otherwise weak company to remain adequately funded during difficult times. CARE Ratings evaluates the internal and external sources of funds available to an HFC in times of exigencies. The liquidity risk is evaluated by examining the stated liquidity policy, the asset liability maturity profile, collection efficiencies, and proportion of liquid assets in relation to its total borrowings. Specifically, CARE looks at the debt repayment obligations of HFCs over the next 12 months and the extent to which cash and liquid assets are available to cover for it. Further, the scheduled inflow from loan assets over the next 12 months is compared with the 12-month debt obligation to arrive at a cover. From a liquidity perspective, HFCs adapting a liability maturity profile which is consistent with the asset maturity are viewed favorably. Any negative mismatch without proper backup is viewed as a risk. In case of entities belonging to a large group, demonstrated support from the group is also considered as a form of backup. Resource profile. Resource base of an HFC is analyzed both in terms of cost and composition. Ability to diversify funding sources is a key factor while rating HFCs. Generally, the entities having major funding from different segments of the capital markets and overseas markets are considered having better diversification of resources. Average as well as incremental cost of funds is examined in the context of prevailing interest rate regime. Ability of the company to raise additional resources at competitive rates is examined critically. In the end, the funding mix should be prudent to the nature of the assets. CARE also looks at the parentage of the HFC and the track record of the operations. While factoring in the parentage, CARE Ratings looks at the parent support in terms of capital infusions, management linkages, business synergies, and brand linkages, which help the overall risk profile of an HFC.
Lost connection.
Apologies for the interruption. We now continue with the trend in the upgrades and the downgrades for NBFCs and HFCs. CARE looks at a modified credit ratio, which is the ratio of number of upgrades plus number of reaffirmations to number of downgrades plus number of reaffirmations. This ratio for CARE ratings is NBFC portfolio, which also includes the HFCs, has remained above 1 over the last 7 years till FY19, indicating upgrades outpacing downgrades consistently. However, the ratio fell below 1 during the first half of the current financial year due to many downgrades witnessed in the NBFC HFC space on the back of liquidity stress seen in the sector. In majority of the years, the NBFC HFC MCR has been higher than CARE ratings overall MCR, indicating greater skew towards upgrades in the NBFC portfolio vis-a-vis the overall rated portfolio. The deterioration in the credit quality was on account of the continuing liquidity stress in the sector, leading to funding challenges for NBFCs and HFCs and delays in deleveraging plans for some of the groups. Next slide, please. The slide shows the rating dispersion for housing finance companies, banks, and NBFCs for CARE. It can be seen that very few HFCs are in the AAA rating category, while majority of the HFCs are in AA category. Some of the other HFCs are in lower rated categories. Broadly, these HFCs can be divided into two segments. Firstly, there are these large HFCs who have a proven track record of over more than 2 decades and have built their portfolios, which have seen various business cycles. Typically, such HFCs are in the AA and AAA rating categories. Most of them have been promoted by large institutions in the financial sector with strong business linkages and have a pan-India presence. The other kind of HFCs are the ones with a relatively smaller size and relatively low vintage, which have started operations recently. The promoters have invested capital or they have been successful in raising funds through private equity investors and are in the process of setting and growing these operations. Most of these type of HFCs target niche segments like affordable housing or have high geographical concentration. Given that their operations are in a relatively initial stages, these HFCs are rated in the lower rating categories. Next, please. Lastly, we look at the outlook for the housing finance companies. The housing finance business model has come under immense competitive pressure, but the overall sector remains well capitalized. Further, the sector continues to face competition from the banks. However, the HFCs with strong parentage continue to grow secularly. Growth in HFC loan book, however, is expected to remain subdued due to funding challenges and lowered consumption due to slowing GDP growth. Most HFCs are looking to conserve their liquidity and correcting their ALM through sell downs and slowing down disbursements. Further, moderation in the loan book growth of the non-banks has curtailed the growth of their interest margins. The borrowing mix of the HFCs is largely expected to be funded through banks and deposits, as trend indicates that short-term borrowings have been replaced with long-term. Cost of borrowing has increased substantially for certain HFCs, leading to squeeze in their profitability. The HFCs have been inclined to move towards higher yielding asset classes so as to be better positioned to absorb the higher funding costs. NIM and ROTA both have declined in September 2019, reflecting the squeeze in profitability. Asset quality, however, continues to remain under control, while there has been some moderation which can be expected going forward. Bank funding continues to remain tight and bond market access has been tough for some of the groups. Overall, HFCs operating at a high leverage have built up sizable real estate books, which is a cause of concern. Further, the negative market sentiment is keeping the lenders in a cautious mode. With this, we conclude the webinar on HFCs.
Thank you, Mitul. Dear participants, we will be having a break of 2 minutes before we begin our Q&A session. In case of queries, you are please requested to key in the questions. I repeat, we'll be having a break of 2 minutes before we begin our Q&A session. In case of any queries, you are please requested to key in. Thank you.
Welcome back. We'll start with the Q&A session. There's a question from Mr. Amit Rane. He asks, what is your outlook on spreads of HFCs in light of competition from banks and unfavorable ALM? Thank you, Amit. I think the spreads for HFCs, I think are going to be a function of their funding costs primarily. The well-positioned HFCs should be better off in terms of passing on the increased costs, if any, to the borrowers. Whereas for some of the other HFCs, it could be difficult to pass on the increase in cost of funds to the borrowers and retain the borrower at the same time. So I think for some large established HFCs, the spreads should remain largely similar, but for the other HFCs, I think they could come under some stress. I hope that answers your question.
So we have another question on what is CARE's view on securitization volume going forward in FY 2021. So if you see FY19, there was a volume about 2 lakh crores overall, including both PTC and DA route. This figure has moved to about 1 lakh crore for the first half of this year, of which about 40% is 42% is about PTC, and about balance 58-60% is about DA route. However, as we have said earlier in earlier presentation, we expect the volumes to moderate because while on one hand there is a larger requirement or need for the HFCs and NBFCs to go for securitization to raise funding. However, there are two counter movements in the market. One is these HFCs and NBFCs have not been able to do significant disbursement in the last 6 to 12 months, and hence the ability to offer originated assets will be lower. And on the other hand, the banking system has seen certain, the investor system has seen certain issues in the last 6 to 12 months related to service, etc., because of which the market is much more cautious. However, it's a developing market, and there could be single transaction, large transaction, which we cannot comment on. Based on this, we feel while the volume will be slightly lower, however, the amount at which the volumes will reside is yet to be seen.
There's another question from Mr. Pankaj. He asks, will mutual fund flows to HFC/NBFC sector improve going forward? I think if we look at the HFC sector, I mean, there are two parts to this. One is that, given that ALM risk, proved to be the undoing of the HFCs, I don't think HFCs would be keen to take up too much of ALM risk. Given that, majority of the funding from the mutual fund sector, which is available, is relatively short term vis-a-vis the assets of the HFCs, I don't think many HFCs would want to take up the tailing risk going forward. Having said that, the stronger HFCs, the ones backed by strong banks or institutions, I think they will continue to kind of get the inflows from the mutual fund sector. There's another question from Mr. Pankaj, who again asks, what is the asset quality outlook for HFCs in the medium term? I think the overall asset quality is expected to remain under control with a bit of an uptick in the GNPA number. This is on account of that we are seeing some stress in the non-HL book, which may play out over a period of time. Also, we have many HFCs which have a relatively unseasoned book, and as their books kind of season, you may see a slight uptick in the overall NPAs. So while the overall sectoral NPAs should remain under control, vis-a-vis FY19 levels, we may see a bit of an uptick in the NPAs going forward.
Yeah, I think that was the last question taken up for the day. We're running short of time. There are a couple of queries regarding the presentation and transcripts of the webinar, which will be sending. If you could write to us in the comment box, which will be coming no sooner the webinar ends. Thank you again to all the participants for being a part of this Care Ratings webinar. We hope it was insightful, and we welcome your suggestions, feedback, or any queries in the suggestion box. Thank you and goodbye for now.